So you have such a small percentage of the economy, of the American population, and everybody in it, and in a leveraged way, we've gone from elevated to worrisome. SoftBank did what some might have said was unthinkable before. It sold its entire stake in Nvidia. Something extremely unusual is happening. The total volume of options traded on the US stock market just hit $3.5 trillion per day. That's the equivalent to the total value of the Russell 2000 index, so basically the value of all US small-cap companies combined. This increase in leveraged bets on the US stock market is something that has been building over the course of the last 5 years since 2020. That happens to be the very moment where the S&P 500 index began to melt up. First, doubling in market size following the pandemic, and then doubling yet again since 2022. These kinds of extreme market returns push people to be ever more confident in the potential for the appreciation to continue, and naturally leads to more risk-taking, as we can see from the total amount of margin debt on the New York Stock Exchange. It recently just hit $1.2 trillion. It has grown by 45% just over the course of last year, which is a level of growth only comparable to the one seen in 2021 and 2008. The usual suspects are sounding the alarm. Ray Dalio, Michael Burry, Howard Marks, and of course Warren Buffett are all getting more cautious on today's stock market. The problem is that when you look at a timeline of all of the instances where famous investors were cautious on the stock market or the economy, it would have made you wait for another great financial crisis pretty much for the last decade. But today it's a fair question to ask, with the frenzy of speculation on the options and margin debt markets, whether the warnings from these investors may be for real this time. So let's take a look at that. This is a chart showing us the 10-year return of the S&P 500 going back 100 years. You can see currently we're at 235%, meaning the S&P 500 has risen by 235% over the last 10 years. This is not something that happens very frequently. It happened in the late 1990s, in the early 1960s, and very briefly in the 1920s. But there is something even more unusual about the strong market returns that we're seeing today. If we add a survey of U.S. consumer sentiment from the University of Michigan that goes back to the 1950s, we see that every time the market yielded strong returns over the course of 10 years, it was generally accompanied by a sense of optimism among U.S. consumers regarding the future of the economy. Today, we've seen the market continue to post record gains despite some of the weakest readings on this consumer sentiment survey going back 70 years. America has been going through a cost of living crisis, leading the average American to feel about as bad as he was feeling during the Great Financial Crisis, and in 1980, when U.S. inflation hit 15%. For the very first time in history, the stock market is completely disregarding the real economic situation and continues to move higher. So from this standpoint, it looks like the stock market is on the edge of a cliff here, that it could snap back to the reality of the real economy any moment. But before you sell your house to go all in on a leveraged short bet on the stock market, let's talk about the elephant in the room, market timing. Because believe it or not, there is a reason for why the stock market is going up right now, despite the poor consumer sentiment. This is a chart showing the expectations of earnings growth for S&P 500 companies over the next 5 years. Now, that might sound complicated, but it basically shows us what kind of growth Wall Street analysts are expecting from the S&P 500 over the course of the next 5 years. As you can see today, they're expecting an 18% annual growth rate over the next 5 years. This is almost double the historical average of around the 10% growth per year. And this is not just random numbers. These are expectations based on real earnings growth that S&P 500 companies are posting, most notably the handful of large tech companies that have made the headlines recently. They've been able to grow their revenues from better ad monetization like Google and Meta, cloud services for Amazon, AI software for Microsoft, and semiconductors for Nvidia. All of these things have very little direct relationship with the state of the American consumer. Investors very much understand this. It's why these companies have been rewarded with the highest market valuations and so the largest weights in the S&P 500 index. And this theoretically can continue as long as we have the right conditions for these companies to continue thriving. And we need to give credit where credit is due. Ray Dalio has been of the exact same opinion, highlighting that yes, we are in a bubble, but that does not necessarily mean we should sell. And we can see that from the late 1990s, which also had very high earnings growth expectations, roughly at the same level as they are today. This period lasted 5 years, and the S&P 500 index tripled over the course of those 5 years. But these high growth expectations also bring clear risks. If we add the valuation of the stock market on top, also known as the PE ratio, it shows us that the higher these growth expectations are, the more expensive the stock market is, and hence more vulnerable to disappointing investors when these expectations begin to turn around. This is exactly what we've seen happen over the last few years, with the forward PE ratio of the stock market being around the same level it was during the dot-com bubble. The question is now, should we expect these growth expectations to begin rolling over? When we look at a 50-year chart of the S&P 500 index, we can point to just a handful of bear markets that have occurred throughout recent financial history. And from our research, there's one key factor that binds each and every one of these together, and that is inflation. When we add the US inflation rate on top, we see that every single one of these crashes occurred when the US inflation rate was trending above 3.5%. And in several cases like 2022, 1999, 1987, inflation jumping above that threshold put a violent end to what had been multi-year stock market rallies. The only exception to this is the market crash that occurred in 2020 when inflation was still below 3%. This crash was a result of the pandemic. Otherwise, every single bout of optimism on stocks was popped by inflation, and there is a reason for this. Inflation is by far the most impactful variable on interest rates, whether that is through its impact on the central bank's policies or by making debt investors naturally seek higher interest rates when inflation levels are higher. The point is that high inflation creates tighter monetary conditions, which restricts liquidity in the financial system, causing selling pressure on assets like the stock market. We've been of the opinion for 2 years now that this bull market in stocks is unlikely to end without inflation really turning back up. In fact, we reiterated our view that inflation would continue trending down in the coming months in a recent video, which would allow the conditions that have been pushing the market higher to stay intact. So while today's stock market might look like a frenzy that is completely disconnected from the real economic reality, the typical catalyst that causes this type of environment to come to an end has not yet materialized. As Ray Dalio puts it, we want to watch for the pricking of the bubble. The moment that inflation picks back up, however, the risks will jump materially. Currently, we are still long with our portfolio of trades at Bravos Research. We have exposure to a few key tech companies that look incredible right now, healthcare stocks that we think can continue to outperform, like Teva that we're up 40% on, and we also have exposure to metals, especially silver and copper, that we believe are setting up for melt-ups in the months ahead.